Hi, welcome to the second part of factor investing. So far, we have seen a broad overview of the factor investing framework. We saw the various large factors that were there. So, there is the risk free return, which is not really a factor, but which is the base rate that anyone would want. And on top of that, if an equity investor were to buy the entire market or the index, one would get something called the equity risk premium. We saw the other large factors like size, value, momentum, uh, beta, and things like that. And we also briefly touched upon how a quality overlay would help. So today we are going to discuss two parts. First part is we are going to discuss the equity risk premium and what are the nuances around that, and then we'll be looking at the quality overlay and some other corroborative factors. So this will be the uh, areas that we will be covering today, and in the later sessions we'll dive into the other bigger factors. So let's get going. So equity risk premium essentially is what you get over and above the risk free rate of return. uh, So if the market return is, let's say, 10% and 4% is the risk-free rate, then 6% can be looked at as equity risk premium. So we have discussed this earlier. Any investor can get risk-free rate of return. The investor simply has to invest money in short-term treasury bill. And people would typically not invest in equity shares unless they at least expect a higher rate of return for taking the additional risk. Uh, yeah, and simply the market return minus the risk-free rate is the equity risk premium. This is essentially the same thing. So the question arises as to, if you invest in equities as compared to, let's say, buying treasury bills, how much return can you expect over the long term? We know that return varies from year to year in equities, but over the long run, how much of a premium should you expect over treasury bills? So it depends on various factors. One is the equity risk premium varies a bit from country to country. So each market does not have the same amount of equity risk premium. Also, it varies over the uh, long term. So if you look at 1 decade, the equity risk premium will be different from uh, uh, what equity risk premium is in some other decade. So it varies from time to time. But broadly, uh, people have seen that at the lower end, it has been as low as 1.4% per annum, and at the higher end, it's been around 6.6% per annum. So that's the broad range that has been calculated for various markets over varying periods of time. But broadly, the gist of it is it's generally a positive number, and median would be somewhere around 4% or thereabouts. So the question arises, how much is the equity risk premium in India? Since we, most of us, are interested in equity investing in India. So the calculation by Professor J.R. Verma and others on the IIM Ahmedabad website is around 3.7% per annum. Uh, so the question arises, if we are talking about the current risk-free rate of return in India of 3%, which is the treasury bill rate, and if we are talking about equity risk premium of 3.7% per annum, are we talking about equity returns of 6.7% per annum? So, which is what this number would indicate. Uh, but of course, currently the uh, times are different, in the sense the short-term rates are extremely low, and we shall see how the future pans out, but the number is not very large, unlike what a lot of investors or even some financial planners assume. So when you uh, come to equity with a priori expectation of I should make 15% per annum return or 20% per annum kind of return, then there is a chance that you would end up being disappointed. The 15% rate of returns were at a time when inflation was close to double digit, where uh, interest rates were 11-12%, and you would get 11%, and you would get some loading on that 11% interest rate to get somewhere around 14-15% return. But in a era where inflation is low, where interest rates are low, the rate of return may not be very high. Now, of course, the question arises: RBI bond is giving north of 7% return, so why should one bother about equity? So I'm not saying necessarily it will be as low as 6 or 7% from equities, but it might as well be 10% or single digit returns in a very low interest rate environment. So one has to take into account this factor. So obviously all of us are very optimistic about the future usually, but the hard number calculated by academics is that equity typically returns around 3.7% per annum over and above the risk free rate. And to get that 3.7% return or 3.9% return, whatever the number is, the up and down is very significant. So this is the calendar year performance of uh, the two leading indices, Nifty and next Nifty, and one can see that sometimes it's a positive 25% number, sometimes it's as high as 150 or 160%, then there's a big negative, maybe minus 50, minus 60%. So the number bounces around a lot, and that is really the difficulty in getting that extra return. So it's not that the extra return comes very easily to people. uh, if it was so easy, then everyone would be an equity investor. Reason why maybe only about 2, 3 or 4 crore people in India invest in equities out of a population of 130 crore people is the fact that it's very scary. Equity investing is not for the faint hearted or not for people who are looking for quick returns, because the returns can bounce around a lot. We have seen that yearly returns vary very significantly, and if you invest for the short term, it's quite possible that the next year return may be minus 30 or minus 40%, in which case you are staring at a huge loss. So it's not for the short or medium term investing, very clearly. So we have discussed this. So when people say, okay, you are talking about long term investing, what really is it? Is it 3 years, as is the lock in for ELSS? Is it 5 years? Is it 10 years? Is it 20 years? So rather than giving you a precise number, we'll look at the how the things pan out for longer horizons. So let's look at some data. If you bought Sensex at the peak in 1992, even after 11 years in the year 2003, you would have a negative return from the Sensex. So Sensex went from 4,200 to around 2,850. So the if you buy in bubbles or if you buy at the peak, the uh, investing period can be really long. It can be as much as a decade long or longer. We have seen US also having a 10-year of a flat kind of period from 2000 to 2010. So sometimes the period can be very elongated. And let's look at the odds of outperformance. Outperformance means you beat the risk-free rate of return, meaning your equity investments do better than your short-term treasury bills. So if you invest only for 1 year, chances are that 66% of the time your equity returns will be higher than your risk-free rate of return. But it also means that 34% of the time your returns may be lower than that of treasury bills. If you invest for 3 years, the odds improve. Only 24% chance of not making equivalent to treasury bills. At 5 year period, the odds improve even more. The chances of making very low returns or negative returns fall to 18%. But still, even at a 5 year kind of horizon, it's not a sure thing. And as we said, sometimes even decade goes by where returns are either very low or negative. So even at a 10-year investment horizon, the chances of outperformance are only 90%, 10% chance of underperforming the risk-free rate of return. And it's only around 20 years that the probability of underperforming the risk-free rate of return really goes down. So this is from the book on factor investing, and I assume the data is for the US stock markets, but this would hold true for most equity markets. It's not that different markets have different characteristics. So the numbers may vary a bit, but essentially the longer the better as far as equity investing goes. And that is really the difficulty of extracting that equity risk premium from the stock market. So this is very scary, right? So sometimes you may start out with a 10-year horizon or a 20-year horizon, but circumstances may change and you may need the money. And if the stock prices are down, what do you do? Or does it mean that equities are a complete no-no for 5-year goals or 10-year goals? So what is the solution to this high volatility kind of environment in equities? So one is have asset allocation. Clearly, equity is not for short and medium term money. The other thing is, if it is a bubble, don't go all in, especially if you think that last 3-year, 5-year returns or recent returns have been very, very high. Uh, Fundamentally, weak companies are doing great, and you are getting stock tips in the elevator. It's most likely a bubble. So then, again, the temptation will be to participate, or so if you don't participate, you may endlessly be waiting for a bear market, and that may never come. So for most people, uh, where income comes in on a monthly basis, either by way of salary or by way of professional income or business income, most people will benefit from regular investing in equity. So we saw from 92 to 2003, equities did not give too much of a return. But instead of buying all the equity in 92, if you had staggered it out, the pain would be far lower. Meaning you would not have made phenomenal money from equities, but you would have participated in the crashes, and your average purchasing price would be much lower than the peak of 1992. So most people benefit from systematic investment plans, rupee cost averaging, dollar cost averaging, those concepts. Again, the flip side of SIPs, which many times gets ignored, is you may have done systematic investing, you would have bought uh, equities in a disciplined manner, but don't overstay your welcome in equities. So if you have expense which is there in another 1 year, 2 year, gradually start shifting some money to fixed income securities, because equity by nature is volatile. So selling your equity, uh, keeping some time margin uh, to your goal time, that is also important. Don't look to sell just one day prior to needing the money, because then you are very dependent on what the stock price is on the date of sale. And finally, equity does not mean the index only of your home country, and we keep harping this on this all the time, and for some reason this has not caught the attention of a lot of investors or a lot of financial planners. And this behavioral bias called home country bias is prevalent in a very strong manner. And we are not, for God's sake, we are not saying this because we run a India plus overseas fund. Even if you don't invest with us, have some allocation towards equities from outside your country. Because what happens is, when you have global diversification, the country specific risk goes down dramatically. Now, in a global pandemic, in a situation where let's say all countries suffer, then obviously there is no protection. But even country specific protection is a big gain. So the pain would be very reduced if you have diversification across countries. So typically people say, even in the argument over passive versus active, people typically talk about Nifty indexing or uh, next Nifty investing or something like that. But really, even if you are a passive investor, choose some other indices to invest in. So the question is, which index do you choose? There is a plethora of indices to choose from. The ideal situation would be maybe something like a MSCI World Index or something like that. But uh, for most people, if you have a India plus a US centric approach, US has global multinationals. So if you are buying companies in US, willy nilly you are getting some measure of global diversification. In which case you need not go to uh, each a Brazilian index or a Mexican index and a Russian index and so on. You have in the US indices, say S&P 500 or something like that, you have uh, companies which operate worldwide, and a lot of ADRs also trade on the US markets. So if you have a India plus a US kind of exposure, most investors would benefit from that kind of allocation, and that would save you some heartburn into going to off into uh, going to frontier markets and the wild west kind of thing, or uh, countries where there's not too much shareholder right protection and so on. So most people would benefit from a India plus US kind of thing. The other question that arises is there any way to reduce the volatility of equity returns? Uh, and the answer is maybe. The answer is probably yes. So there should be potential structures which would reduce the downside for equity investors. And here one can use some of the quant toolkits and figure out how to do it. And we have seen the attraction of such kind of structures, especially among HNIs, where they invest in index linked debentures, where the capital is protected and they get a defined percentage of the upside and things like that. So these kind of products would have a lot of appeal for investors, and one can structure these uh, using some fixed income instruments, some hybrid between equity and debt, a little bit of index options and things like that. So most people would want a smoother ride, and that would attract a lot of investors who are currently not participating in equities to try out equity investing and benefit from the wealth creating potential. So in some cases it may reduce some upside as well, while reducing the downside, but most people would like such kind of a thing. So instead of uh, plus 100% and minus 50%, if it was plus 50% and minus 25, most people would uh, agree to such kind of a transforming of the payoff profile. So that's the brief discussion on the equity risk premium. uh, it's not as large as a lot of people suspect. So people typically come with the expectation I should get more than 10% as compared to my bank FD or as compared to short term fixed income returns. Typically, you should expect 4 to 5% kind of thing. It's not a very uh, large number over fixed income securities. It can range from 1 to 6 kind of thing, or 1 to 7. So keep your expectations in check. That is one. Secondly, keep a long time horizon for equity investing to really benefit from that equity risk premium, and do systematic investing, redeem your equity investing in time before your goals, and finally uh, figure out a way of how to reduce the volatility. Largely this has to be done by investment managers, but you should be aware of the fact that there are mechanisms by which you can reduce the equity volatility, one of which is global diversification, and there are other things also which can be done to reduce equity volatility. Now we move to the second part of today's presentation, which is corroborative factors. So corroborative factors are not factors by themselves or standalone. Maybe some people would be using them as standalone factors, but I am mainly talking about these factors working in conjunction with the other factors that we have discussed in the first episode of factor investing. So the other main factors are things like size, value, momentum, beta, and those kind of large factors. So corroborative factors will operate in partnership with the other large factors. So one of the first factors is quality. And there is this interesting paper on the AQR website where it says that if you remove the junky small caps, then uh, the size factor works beautifully. And without controlling the junk stocks, the size factor does not have that big of a premium. So obviously size plus quality can do wonders, but quality is not only relevant for small cap or mid cap investing. Quality in my view is important for all factors. So it's better to have a good quality value stock than a bad quality value stock, and a good quality company with positive momentum than a bad quality company with positive momentum. So this is the price chart of a company, and I've deliberately removed the name. So name is not important. What is important is the steep fall in the light blue line that you can see. Now was a company where uh, value investors were buying it as a small company, small cap investors were buying it. Uh, the stock seemed to have positive momentum, maybe some traders and momentum investors would be buying it, and then you see a sudden steep decline. Why did that decline happen? It was not due to any macro factors. It just turned out that the company was fraudulent, and you can see that the company had a vertical fall, and uh, it was actually circuit to circuit. So even if you had a stop loss in place, or even if you wanted to exit after the fraud was identified, there was no exit for many days or maybe months. So this is what happens when you buy bad quality. So it may be enjoyable for a while, but then you get into trouble. So quality matters whether you are using the size factor, value factor, or the momentum factor. And quality itself can be classified into two buckets. So let's see what those buckets are. The first thing is to avoid bad quality. Bad quality meaning absolute trashy companies. And how do we define bad quality? One of the frameworks given is, firstly, it should not be fraudulent, meaning they are showing sales when there are no sales. They say they have a factory when there is no factory. They say they have 1,000 stores when they hardly have 100 stores. So first is out and out fraud. The second is uh, on a very low floating stock, you ramp up the stock price and you show positive price momentum, or you manipulate the reported earnings by using all the financial shenanigans, and you show rising EPS or rising profitability. So which is stock price and or earnings manipulation. And third is where the company is continuously on the edge. They've borrowed so much money, their interest cost is so high that the slightest amount of turbulence can take them into bankruptcy. So largely, if you avoid these three things, if you avoid fraud, if you identify companies which are indulging in stock price manipulation or earnings manipulation, and if you avoid bankruptcy risks, you get the first part right. And that improves the result quite a bit. So you eliminate the junk, but that is only part of the equation. Eliminating junk does not mean you are buying great quality. So the second part is, you want, after eliminating junk, but from the remaining universe, from the remaining companies, you also want to buy things which are top notch. So how do you identify those? So typically these are the kind of companies that Buffett has talked about, or other people have spoken about. You want companies with high return on capital employed. You want opportunities for growth and reinvestment in the companies that you are investing in. The company should be spending a lot of money on R&D and uh, marketing spend on growth. So this will be depressing current earnings. So current PE may look high, but actually it's reinvesting for the future. So the future will be very, very high. So this results in high quality of earnings and high future prospects. So that completes the quality part. Apart from quality, there are other corroborative factors which actually give you signals that something interesting is happening here, and these are the stocks which will uh, result in outperformance in your portfolio. So one is where the company promoters announce a buyback or announce an open offer. Now, there is some nuance involved in this aspect. So you cannot uh, equate all buybacks with the same yardstick. Now, some people may be buying back shares to neutralize the effect of issuing ESOPs. Now, that doesn't really help too much because the equity base remains the same. Whereas if a company which has never been issuing additional shares, or which has not raised capital for a long time, suddenly comes out and announces a big buyback, then obviously that's a huge signal. Or if the promoter group or some strategic partner announces a big open offer, obviously that's a big signal for minority shareholders to look at what's happening and consider buying additional shares. Same goes with insider buying, and on the flip side, selling. So if company insiders are buying large quantities of shares from the open market, obviously they are positive about the prospects of the company. Uh, at the same time, if they are dumping their existing holding of shares, then they are not too positive uh, on the prospects of the company. So again, some nuances involved. The ESOPs may tamper with the signal a bit. Some people may be selling shares to raise cash to buy additional shares in ESOP and things like that. So here you should look at if insiders as a group across various designations, all of them are dumping, then it's a very bad signal. If multiple senior people are buying shares, then that's a very positive signal. And even in companies where ESOPs are offered, what the employees do after getting ESOPs is also an important signal. Do people just buy shares and immediately dump in the market, or do they hold on to the shares because they are positive about the prospects of the company? So that's an important signal to watch out for. Again, what are activist investors, what are other smart investors doing? So that's again a corroborative signal in the quant framework. So when you combine all these signals, you get a strong positive or a strong negative signal, which will tell you what to do. Again, if there is a hostile takeover attempt or things like that, then that's a signal that cost efficiencies will come in, unprofitable units will be sold out, there could be a bidding war where stock price will go up. So all those are positive signals. So that's all for the second part of the session. So this one is a smaller presentation as compared to the other ones. So I just wanted to get the corroborative signals and the equity risk premium covered, and next we will dive into the bigger factors, which is size, value, momentum, and beta. Thank you so much for joining us.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.